Hey, what's happening, guys? What's going on? Terry James, your mortgage guy, coming to you. Today, I want to talk about something that a lot of people have questions about, which is how to buy an income producing property. Can you qualify using the rent from the income producing property, or the rent you're expected to receive from the income producing property? And so the first thing I want to talk about is that yes, you can use the income, even though you haven't received it yet, even though you don't have a renter, you can use that income that you're expected to receive to help qualify for that income producing property. Okay. And so what you need to understand about that is when you go to purchase a investment property, and they're going to have, as far as you have expected rents on it. So because you're not a renter already, okay, so we're talking about those of you who is buying your first investment property, buying your first rental, because you haven't did that already, it's not on your tax returns, so we don't have anything to go off of. How they do that as a lender is they allow you to use 75% of the income. So 75% of what you're expected to receive, you are granted as income for that property. And so what that means is that you take what's expected, you say, okay, I have a property, they're going to give me, XYZ dollars. 75% of that you can use as income to help you qualify. Now, to understand that when it comes to debt to income ratio, they are still going to count your full mortgage payment on both of your properties, or however many properties you have, your taxes, insurance, HOA fees, all of that is going to count against you, but they'll give you as income of 75% of whatever the rent is. Now, how is that rent determined? How do we figure that out? Is it just going to be, yeah, I'm going to rent this place for $5,000, even though the rent is only $1,000? No, they're not going to take your word for it. What they're going to do is when they order the appraisal, they're also the lender is going to order the appraisal, of course, that's done on every loan. They're going to order what's called a rent schedule or a rent summary, however lender dictates it or what they call it. But what that means is that eventually when the appraiser goes out, they're going to appraise the property, number one, to make sure that it's for the value that the loan is going on for the lender. And then number two, they're going to run a rent schedule, which means they're going to run a report that says, based upon the area, based upon how many bedrooms and bathrooms of this property, this is the rent that is expected to produce in this property. There's a rent that you can get. That number right there is going to be what the lender is going to use as the 75%. Okay, so you can't just write anything and say, hey, yeah, I'm going to get $6,000 for this place a month. No. So that's the thing you got to understand. So once they have that number, that 75% will now go in as income for you. And that is what you can use to help calculate and what will be used against you or for you when it comes to your debt to income ratio. Okay, so that's one of the quick things. Also, keep in mind that what a lot of people do, and they find this out after the fact. So let's say you have a home right now and you want to buy property number two. Congratulations. Good job. This is what you should be doing, right? But what a lot of people do is they begin to pull out a home equity line, okay, to do that, to invest in that. Now, a couple things about that. Now, you already know, as I've said before in other videos, when it comes to HELOCs, it's a great way to start your wealth building, and it should be used to do stuff like this, to get investment properties, things that are going to make you money. That's what I believe the HELOC should be for, right? Now, the only thing about that is keep in mind is that when you do that, how the lender is going to take that payment, because on most HELOCs, you're paying an interest-only payment. So you're not paying principal. You start off paying interest only. So your debt-to-income ratio is not going to be calculated on that interest-only payment. So let's say you have a HELOC and that payment is $250, right? For whatever balance you have, whatever you took out to buy the investment property. One thing you want to keep in mind when it comes to the HELOC, as a payment, the lender is going to use 1% of your max balance. So if your max balance is $100,000, 1% is going to be $1,000 payment. Okay. So that's the thing that you have to understand. That's the thing you got to realize is that that $1,000 payment, HELOC payment, is now what's going to factor in into your debt to income ratio. Okay. So while it's a great tool to use, you have to keep in mind that you make sure all your numbers work before you take that HELOC out, before you go forward with taking out the cash to buy that investment property, to buy that, that other property you plan to. You want to keep in mind, do my numbers work? So before you apply for the HELOC, before you take that HELOC out, because remember, once again, like I said, we're planning. We're not just doing this spur of the moment. Because you're planning, you want to start calculating, okay, I'm taking a HELOC out for $200,000. So I know the payment on that is going to be 1% is what's going to count against my DTI. And I've already showed you in other videos how to calculate your DTI. Now you're going to throw that in, include the new home mortgage payment, right? Got to throw the new home, what's expected in that. And then you can also include for income, you can include 75% of the rent that you're expected to get. So because we're planning now, guys, we're not just out there just doing stuff and hoping things work out. Because we're planning, you have time to check resources. So now you go online, you see, okay, well, I see a house that's for rent in the area. What are the bedrooms? What are the bathrooms? You can check with a realtor who can also give you some great information. They're a great source for telling you what rents are going for in a certain area. So once you find that out, you're planning so that now when you know what the payment is, you know how much you can afford. That's where you sit down with an expert. Okay. So you sit down with a lending expert and we start planning this out before you make any moves, before you pull the HELOC out, before you do this, before you start making an offer on a second home, before you start looking at that, let's plan it and then we figure it out. But to get back to the original thing, yes, you can use the income from your rental to help you qualify for that rental property, for that investment property. All right. So if you have any questions, always remember, hit the like, subscribe, comment. I get back to my comments, subscribe, so you're always aware of whatever videos are coming up. All right, until next time.